Global finance currently operates in two parallel universes. On one side, hyper-fast digital networks move data at the speed of light, 24/7. On the other, the physical economy remains massive, tangible, and incredibly heavy. The traditional financial system is built around these physical realities. It relies on clearinghouses, paper trails, and manual verification. That infrastructure dictates a rigid schedule, meaning most of the world's wealth goes to sleep at 4 p.m. on Friday and doesn't wake up until Monday morning. Early cryptocurrencies swung entirely in the opposite direction. These digital assets existed completely isolated from the physical world. We even manufactured novelty physical coins just to help our human brains grasp a concept that lived entirely on a decentralized ledger. For the past decade, these two economic engines have run in isolation. The legacy system has stability but lacks speed, while the blockchain has speed but lacks connection to the tangible economy. That separation has capped the potential of both systems. Crypto's first major waves, digital currency and NFT artwork, functioned as closed loops. The assets were created online, traded online, and stayed online, never interacting with the broader economy. This insular ecosystem eventually hit a ceiling. Mainstream retail brokerages realized that long-term survival required offering assets with intrinsic, real-world value that appealed to more than just early adopters. Major brokerage leaders are now signaling a strategic pivot. The CEO of Robinhood suggests that the next major phase of crypto adoption will be driven by real-world assets rather than new digital tokens. The industry is now focusing its efforts on migrating the existing physical economy directly onto blockchain infrastructure. This migration relies on the concept of real-world assets, or RWAs. This relies on tokenization, taking a tangible object and generating a legally binding digital twin on a blockchain. The token serves as a verifiable deed of ownership. Once that legal link is established, the technology can be applied to almost anything, from commercial real estate to agricultural commodities and government debt. Established financial entities are already converting treasury bills and traditional U.S. savings bonds into digital tokens, moving them away from aging paper systems. Linking a token to a physical object transforms the asset. It moves from a speculative instrument to a highly efficient vehicle for transferring real property. Applying blockchain architecture to physical property unlocks the mechanical advantage of fractionalization. Buying a commercial high-rise normally requires hundreds of millions of dollars. Tokenization allows that same deed to be divided into thousands of affordable microshares, lowering the barrier to entry for smaller investors. These shares also benefit from digital settlement rails. Instead of waiting days for clearinghouses to approve a transaction, these tokens transfer globally and settle instantly, regardless of the time or day. Retail platforms are betting on this convenience. It allows an investor to use their phone to acquire a fraction of a skyscraper at 2 a.m. on a Sunday. Tokenization targets the trillion-dollar inefficiencies of physical markets, effectively erasing the friction of slow transfer speeds and geographical borders. This dynamic represents an essential architectural upgrade for global finance, framing decentralized technology as a support layer for legacy banking. We are now witnessing a quiet merger as established financial institutions partner with Web3 builders to overhaul their internal plumbing. The capital involved is staggering. Trillions of dollars in national wealth, physical commodities, and corporate debt currently sitting in analog systems are being prepared for on-chain migration. By embracing real-world assets, cryptocurrency sheds its reputation for volatility and becomes foundational infrastructure for global trade. This institutional shift will eventually erase the borders between different asset classes. The barriers that once required separate accounts for different types of investments are beginning to collapse. We are moving toward a unified market structure. Here, physical real estate, commodities, and digital data all trade simultaneously on the exact same layer. The retail platforms that survive will be the ones that successfully bridge this gap, delivering a unified market directly to the consumer. The ultimate success of blockchain technology won't be found in displacing the physical world, but in completely absorbing it.